All right, welcome to everyone attending today. Today I'm going to go through a notebook that I recently posted in the forums. The post was intended to show a workflow that takes advantage of all of what we consider to be the best features of our product. That includes the partner data sets that are available in research and in pipeline, the pipeline API itself, alphalens, which allows you to evaluate alpha factors, our back tester, as well as pyfolio, which gives a comprehensive analysis of back tests. So to start out, maybe let me give another sort of big picture view of, I guess in the title we said how to get an allocation. And what I just want to add a disclaimer that this is not going to get you an allocation, just following this lecture or this webinar. But what it is going to do is it's going to show you sort of a lot of the features that we look for in algorithms when we evaluate them. So at some point in this call, Jess, who is on our investment management team, that's Dr. Jess Stauth, she's going to come through and help us analyze the alphalens results that we get, as well as the pyfolio tear sheet that we get from a backtest, which we're going to build up to. But before we get to that, let's start with research. So research is the first step to interacting with and investigating data that we have to work with. So as most of you probably know, we have free pricing and fundamental data, but we also have a collection of like 60 other partner data sets right now on a growing list. And those data sets include some traditional event-based data, but also some less traditional, newer sentiment data. And most of those data sets are available on a freemium model, which means that they have a period of, you can get the data free from let's say 2011 to 2015, and then more recent or live data you can get a premium subscription with. Everything I'm going to do in the notebook today is available at least premium, and the data I'm looking at is free. So I'm going to be looking at Centdex, as well as two event investor data sets being earnings calendar and the mergers and acquisitions data set. All right, so let's get started with the Centdex data set. So there's a tool called Blaze that we have that allows you to interact with the partner data sets that we offer in the research environment. So we don't have too many examples using Blaze right now, but it's something that is really a powerful tool because it allows you to interact with data without having to pull all of the data into memory. So there are memory restrictions in the research environment, but Blaze kind of helps you get around some of those by allowing you to define expressions that you can then map onto the data before getting results. So what that means is if I want to get, let's say I'm looking at 10,000 data points and I want to get the mean of only the ones that pertain to Apple or something. Blaze will allow me to only pull in the subset that's relevant to my query and then perform the computation. So I don't want to say too much more about that because I'm not one of the engineers behind it, so I don't want to say something incorrect. Instead, I'm just going to show you what I can do with it. So I'm just going to cheat a little bit here because I have the full notebook that I posted in the forums here, and I'm going to show you what I started with. So the first thing I'm going to start with is I'm going to pull in the sentiment data set from quantopian.interactive.data.centdex import sentiment, as well as some of these other libraries, which I'm going to use later. But then I'm just going to go sentiment.peak. And peak is very similar to head if you're familiar with pandas. And this kind of gives me a view, like a little preview of the data that I'm looking at. So this is not all of the sentiment data, it's just 10 rows coming from the start of the data set. So Centdex, when it started, I think they were only sending us sentiment for Apple on the first few days. So this is that's why you only see Apple right here, and you can see the as of date. These are the days from which the sentiment applies. And so I'm going to go back to my complete one here. Okay, so now let's say I want to get some of this data, but only look at data from 2013 or more recent. I'm going to take this filter here, go back. I'm going to create a mask. Recent data equals sentiment.as of date is greater than or equal to December 2013. And now this is very similar syntax to Panda, so I'm going to go sentiment data. And I'm going to look at what it's like. And now I have some data from later in 2013, and now you can see it's all from the same day because we're getting sentiment for many more tickers. So it's just because at the beginning, Centex, when I guess it was starting out, didn't have sentiment for everything, and now they do, or at least for a much greater collection of stocks. So from here, let's say I want to look at this sentiment signal for a particular ticker. And let's stick with an easy Apple. So I'm going to go Apple SID equals symbols L.SID. And I'm going to show you what that looks like. SID, so this is just the number 24. Which is a security ID for those who are not familiar. And then I'm going to go sentiment, and I'm going to go sentiment.sid equals Apple SID. And then I'm going to go and I'm going to take my recent data mask. I'm going to go down peak. So this is going to show me Apple sentiment data starting in 2013, December 2013. Now, there are some limitations here in research on how much data we can print in table format, but we can plot this data from 2013 all the way to the end of the free data set. So what I'm going to do, actually, before I do that first, I'm going to show you this line. So Blaze allows you to define expressions, which you can then compute to get you the result of the expression. So in this context, what I'm doing, I'm building an expression which is get me this column. I'm going to go back up here. Get me this column of SIDs for all of my sentiment data. Get me the distinct values. So I'm trying to find how many distinct securities are in this data set, and then count that number of distinct SIDs. And this part itself is just an expression. And then I can put this into up here I imported Blaze as BZ. And then here I'm going bz.compute. So the compute function takes an expression, evaluates it, and gives me back the result. So here num_SIDs is the result, which will be to count the number of SIDs in the data set. And when I run this, I can see that there are 586 SIDs in this data set. So we're dealing with a data set that doesn't cover all 8,000 stocks, but covers a pretty good number of them. And then from here, I'm going to go back and steal some more code. And I'm going to cover this. So again, up here, I imported something from Zipline, which is our open source repository of our backtester. And I imported what is called get trading days. So get trading days gets me all of the trading days over a specified time period. So it excludes weekends and market holidays. And the reason I'm importing this is because if you note in the Centex data, there's data on weekends. So we have data from December 1st, 2nd, 3rd, 4th, 5th, 6th. So it's seven days in a week right there. And we don't want all that because we can't access all of that in an algorithm. So I'm going to run get trading days between December 2013 and December 2014. And what this is going to do is I can use this as a date mask, and then I can use my earlier stock mask, which was my Apple SID. And I can run this, and it'll get me all of the Apple sentiment in between December 2013 and December 2014 for trading days. All right, and now to plot this. So actually, first I need to compute this expression. So this is just, again, a Blaze expression. In order to actually get the data, I need to compute it, which I'm going to do. And now I'm going to plot it. So this is going to plot my expression, or my resulting data frame. So actually, before I do this, I'm just going to show you what this looks like. 2014 df. Oh no, this is a pandas data frame, so .head. And it just looks like a regular pandas data frame. And now I can plot it, and I'm going to set my x-axis to be this as of date, which is when, yeah, it's just the date, and then the sentiment signal on my y-axis. All right, so this is our sentiment signal for Apple over the course of the year between December 2013 and December 2014, and it looks like it jumps around a lot. So clearly it ranges, the range here is between -3 and 6, but really it's a little bit all over the place. So if I want to make use of this, I might want to try smoothing it. So to do that, let's take a mean of this value, like a rolling mean. And the example I had in the notebook was a 5-day mean. So to do this, I used the pandas rolling mean function on a data frame of the series, which is my sentiment signal here. And I did this set index as of date so that I would get the as of date in my axis. And for the rolling mean, I used a window of 5. So this is going to take the 5-day mean each day, and I'm going to plot that. And as you can see, it's still a little all over the place, but it's quite a bit smoother. I could change this to, let's say I wanted a 20-day rolling mean. Again, like even smoother here. But for the sake of this presentation, I'm just going to keep it at 5. So that's a bit of a snapshot of Blaze. So I'm able to poke around the data, and remember how I mentioned that most of the data isn't actually pulled in here. So I'm using the entire sentiment data set, but I'm only pulling in the data that I need to plot here, which is all of the Apple sentiment data. So yeah, on to the next step. I'm going to try using this signal in a pipeline. So for those who are not familiar, pipeline is the way that you can interact with partner data sets and pricing and fundamental data in both an algorithm and research. You can also access minutely pricing in algorithms through a different part of the API, but pipeline lets you get daily pricing and any of the data sets. So if we want to use this sentiment signal in our algorithm, we're going to have to put it in pipeline. A lot of people try to jump straight to the IDE to start writing a backtest using this signal right away, but it's actually a lot easier to iterate on a pipeline in research. So I'm going to stick in research for now. And I just included a bunch of these imports. They're in the notebook, but essentially this is our pipeline right here. Run pipeline is what allows our pipeline to be, is what we use to compute our pipeline, and I'll get to that in a minute. And then this is a built-in factor, simple moving average that we'll use. Q1500 US is a universe that we have defined to be kind of a high liquidity group of stocks, excludes a bunch of things like ADRs and ETFs. It's like it's not quite an index. It's just a group of stocks that we thought would be convenient to put into a filter here. And then here's my sentiment data, and here I'm importing it from pipeline so I can use it in my pipeline. And then these are some other factors which I'll get to in a minute. So with pipeline, there are kind of two components. There's the first part is the definition of a pipeline. So we define our pipeline to have a certain set of rules. So a simple example would be, I want my pipeline to only include stocks that have a sentiment of above 3. We're going to do something slightly more complicated than that, but a pipeline could be something as simple as that. And that's the definition of the pipeline. And then the second part is actually the computation of the pipeline. So in research, we use run pipeline to compute our pipeline over a particular date range. So if I want to say, let's say I want to get all the my pipeline to filter out everything except for the stocks that had a sentiment of 6, I could define my pipeline to do that, and then I would run that pipeline and kind of get the results day to day. When we get to putting this in an algorithm, I'll explain how it's slightly different in algorithms. But for now, I'm just going to use run pipeline and define it. So for this example, I'm going to create a factor which is my 5-day sentiment signal. So I'm actually going to write a function here called def make pipeline. And make pipeline is going to, it's just going to be a wrapper around the creation and definition of my pipeline. So I'm going to say return pipe. And pipe is, I'm going to define pipe to be my pipeline. So first thing I want to do is I want to create my sentiment factor. So above, we decided that, or I decided that I'm going to do this rolling 5-day mean of the sentiment signal. So to do that, I can use the simple moving average built-in factor, and I'm going to pass as input the sentiment signal. So this is the sentiment data set, and I'm saying I want to pass the sentiment signal column, which we saw to be up here, this one, as input. There you go. And I want this to be over a window length of 5. So this is going to create my sentiment factor, and actually I'm going to show you guys kind of incrementally what this looks like as I run it. So I'm going to say pipe equals pipeline, columns, and I'm going to add my sentiment factor as a column to pipeline. So sentiment factor. So I'm imports from define my make pipeline, and now I'm going to actually run this pipeline. I'm going to go make pipeline. So I'm going to run make pipeline here, which is going to evaluate to, it's going to return my pipeline here, which I defined. I'm going to run this between 2013 1201 and 2013 2014 1201. And what this is going to do is it's going to compute my pipeline, which has this one factor here, which is the sentiment factor, 5-day simple moving average. And so that's done, and I can go result.head. So run pipeline actually returns a pandas data frame, and then I can get a look at this going result.head. So this is telling me that on December 2nd, 2013, ARNC had a 5-day average sentiment of -0.6, Apple had +0.6, and all these other ones weren't in the data set. I can give you a slightly better view here. So there's some more, here's some more numbers. But really, I don't want to include any of these NANDs. They're not in the data set, and so I can't really make any decisions on them. So I'm gonna add a screen to my pipeline, which filters out anything that has a NAND sentiment. So I'm going to say, I'm going to create, this is a filter. I'm going to say has sentiment is sentiment factor dot not null. So all of this is available in the documentation, but sentiment factor is a pipeline filter, which has this function not null, which is this all evaluates to a filter, which tells my pipeline I want things where sentiment factor is not null. I'm going to add that as a screen to my pipeline. Sentiment. I'm going to rerun that. I'm going to show the head. And here I have my, I'm only looking at stocks that actually have sentiment value. So, all right, that's a good start. But let's, I showed you I talked about this Q1500 here briefly. This is a universe that is really a group of liquid stocks. And when we get to the point where we want to write an algorithm about this, we want to be trading liquid stocks. So I'm going to specify my pipeline to select from the Q1500. So I'm going to create a universe filter. I'm going to say universe equals Q1500 US. And I'm actually also going to say has sentiment. And here I'm going to change this filter to be universe. And when I run this, now all my stocks are going to meet both of these criteria. Waiting a second. All right. So all of these stocks here both have sentiment value and are in the Q1500. So I'm going to do the next couple factors a little bit more quickly, but I'm going to add some filters such that we avoid stocks that are within 2 days of an earnings announcement and stocks that have been announced as acquisition targets. The goal behind those is to reduce volatility around those periods. I think there's some posts in the community that show why how there's volatility around earnings announcements, and as well with acquisition announcements. So I'm going to create 2 more filters, one being not near earnings. I'm going to say equals. I'm going to take my factor here, business days until next earnings. So this is here, and I'm going to say that has to be less than or equal to 2. And then I'm going to say, and business days since previous earnings also has to be less than or equal to 2. And since I want to avoid trading these stocks, I'm going to negate this filter with the tilde. And now, so this is gonna filter out any stocks that are within 2 days of a earnings announcement. And now I'm gonna create not acquisition target, and I'm gonna say we have this factor here is announced acquisition target. I'm gonna say it's not, again with this, not an announced acquisition target. And so both of these are filters that I'm going to add, and I'm actually going to want to add one final one, which is new info. And with new info, I'm going to say I only want to include stocks that have received new data for the sentiment signal within the last day. Whether that new data is a new value, that's not important. I'm just going to say I wanted that stock to have received new data recently. So to do that, I'm going to go business days since previous event. And I'm going to pass my sentiment.asofdate.latest. So this is actually passing a factor as input, and I'll specify that. And now I'm going to add all of these filters to my universe. So I'm going to say it's in the Q1500. It has sentiment. It is not near earnings. It is not an acquisition target, and it is new info. So this is my new universe here, and run that. It's taking a little bit longer because it's reading a little bit more data. And because I had an error, well, I'm going to cheat, and I'm going to copy from the version that worked. And it looks like the difference is, I forgot to assert that I want this new info to be, I want the business days since the last as of date in my sentiment data to be less than or equal to 1. So while that's running, the next thing I'm going to do is change my factor to, so right now it is giving me the actual sentiment score, but what I want is the rank of the sentiment score. So I want to see how the stocks rank up against each other, and that's what I'm going to use when I go forward to alphalens. So here I can see my sentiment scores, but I'm actually going to rank these by the sentiment factor, which is, again, the 5-day mean. And I'm going to add a mask, which is my universe. And I'm going to say, as a tie-breaking method for ranking, I'm just going to pick average. And so what this is going to give me is a pipeline every day, which ranks all my stocks that meet these criteria here. So in the Q1500, they have sentiment score, not near an earnings event, not an acquisition target, and has new info. And it's going to rank them, which here, these are the ranks. And I'm going to use these to determine which stocks to trade each day later in a backtest. But before I do that, I'm going to put them through this tool called alphalens. So alphalens allows you to, it gives you a lot of information about your factor in relation to pricing data. So it compares a factor to forward returns, and it gives you a bunch of sort of plots that you can use to analyze your factor. And Jess is here, and she's actually going to join for this part of the call, so she can give us some color around some of the plots that we get. So my result, I called my column sentiment, and so I'm going to pass, so this result here is the output of my pipeline, and I'm saying pass the sentiment column as input to alphalens, I'm going to create 3 quantiles to look at, and I'm going to look at 1-day, 5-day, and 10-day forward periods. So I'm going to run that. And now we have some plots. Oh, not yet. It's coming.
You're braver than I am to be running all of your notebook.
I cheated. I have the solution.
Okay.
What's going on here?
I think it's still, you still have your plots, right?
Yes, they're a little different. I don't know what's happening here. So we're going to just go back to this one, the one that we looked at earlier, and the one that's posted in the community. Okay, so
I think this is just like a deprecation warning.
Yep.
It's not. Okay.
Yeah, I'm not worried about that.
Okay.
So where do you want to start from?
Sure. So Jamie thought it would be helpful maybe if I hopped on to just sort of look and give a walkthrough of how I might analyze an alphalens report for a signal or like a data provider that we might be looking at. So I run the research team at Quantopian, and we spend a lot of time trying to understand and evaluate raw signals, process signals, data sources, as well as trading algorithms that folks in the community have written. And my background is in equity stock selection factors. So in my first quant job, I worked for a company called Starmine, and we did a ton of reports just like this, where we would just try to look at transforming a signal into some sort of ranked value and trying to understand, where and to what extent and what can we learn about predictive power about future returns. So what's nice about this alphalens report is that, it sort of packs a bunch of information into one analysis that would take a lot of time and effort to accumulate over a lot of different back tests, simulations that would sort of be more cumbersome. So what we sacrifice a bit of a bit of accuracy from like a full simulation where you might include costs and trading details, but you can get a much quicker general sense of, is there signal in this data? So just taking a look, I'm just going to skip around on like a couple really sort of simple things that I think we like to look at. So you start off with having a 1, 5, and 10-day annual alpha forecast. We're not going to get too bogged down in sort of whether a lot of these numbers are like big or small. The signal looks interesting. And what we'll see even in looking at the alpha forecast over 1, 5, and 10 days is that that number is getting smaller, right? So we think this signal maybe is more predictive over a 1-day horizon than it is in the longer term. The information analysis table below, IC, that's an information coefficient. That's actually like both a really sort of rigorous statistic to look at, I guess, in terms of it's tough to get a good value. An IC of even 0.1 is really good. Even 0.01 is still pretty good. So this IC is not so great yet, but we're really just getting started, and it's positive. So okay, that's interesting. What the information coefficient is. It basically says what's the rank correlation between my factor values that I know today and the returns that I find out in 1, 5, or 10 days. What's really nice about that statistic, I think, is that you get to throw out and not care about sort of the variance basically in your data. And so you can have data sets on different timescales and might be very noisy, and you can compare the ICs across lots of different data sets and expect it to be a little more robust. So there's a lot in that table. Skipping down, we're looking at turnover in these 3 quantiles that Jamie has created. We'll revisit and talk about this later, but this is a pretty low turnover that we're seeing, and the factor autocorrelation is actually quite high. So that's something that we'll come back to, I think, and talk about when we get to sort of the end of this. That's sort of a point where we probably want to come back and think a little bit about how the signal is designed. Now we're looking at the mean return by factor quantile. So here, what you want to look at is the spread between sort of the N2 quantiles. So here it's 1 and 3. And in blue is our 1-day forward return. And so exactly what you're looking for, stylistically looks great here, which is that in quantile 1, these stocks are expected to go down, and in quantile 3, in value and price, in quantile 3, they're expected to go up. So this is just the kind of thing you want to see for, sort of a stat arb style quant selection process is, hey, I bet I can long one basket of stocks and short another and make a lot of my other risk factors neutral, and I should just make a consistent profit, right, which is what you're looking for. The next plot, which I was really sad to hear Jamie say that he hates violin plots, because I actually really like violin plots, or at least I like error bars on plots, because if you think of that first plot we just looked at, it looks like so super clean and crisp, right? Like, oh, there's a spread of 1.5% between the top and bottom quantile. Well, really, of course, look under the hood, and this data is very, very noisy. So these violin plots are showing you, the midpoint of the data, and I think it's plus or minus 1. Okay, yeah, quartiles
or something, some sort of range.
Yep. And so you can get a sense that, the data, there's a lot of variance in the data. So we're sort of taking it with a grain of salt, but we're going forward. The next plot that we look at is just, we've got a 1 year of data that we're looking at. And so this is sort of simulating, well, what would a portfolio have returned if I longed the top quantile? Is that right? Long, short. Yeah. I think so, yeah. I think it's basically the spread between the top and bottom quantile that we looked at. So, okay, this is going in the right direction. Actually, the next plot I usually find kind of more cool, because with a back test, you're going to get that cumulative return plot for your strategy. What's really nice about this next cumulative return by quantile plot is what you're looking for is to see that your signal actually sorts into multiple baskets that are ranked the correct way. So exactly what we see here is kind of what you're looking for, which is you've got, your top quantile, which are stocks that as a whole increase in value. Your middle quantile is meh, and your bottom quantile are stocks that actually decrease in value. So you could imagine if we had a much more granular signal, we could run, a decile analysis here and have 10 buckets. And the perfect thing you'd want to be seeing would be, absolutely, monotonically increasing performance from your top half, quantiles, 6, 7, 8, 9, 10, and then monotonically decreasing performance for the bottom half. So this is cool looking and what you want to see. And I'll point out that, a lot of times you can build a portfolio where when you pick just your portfolio, it happens to go up. But when you break it up, your signal up into quantiles, you'll see that like you got lucky by your long and short baskets diverging, or maybe they didn't consistently. And some of the other baskets, like maybe it looks like, oh, it would have been more profitable to be long the middle quantile and short the bottom quantile. If that happens, then you'd want to kind of go back and say, like, okay, this doesn't seem like I'm monotonically ranking my signal in a way that's predictive. So now we've got sort of some lower pass filtered versions of these, like over the forward. I guess this is over 5 day and 10 day. So these are a little less compelling looking because we think the 1 day is where we seem to have like compounding performance.
Yeah, and you can see that here in this plot. They don't have that same nice pattern.
Right. You're sort of losing the predictive value of the signal, perhaps, if we interpret it that way. And now we're just looking at zooming in on, what's the difference in that top and bottom quintile or quantile, over time. So we can go through those. So this study we don't want to spend too much time on, but actually was explaining and saying to Jamie, like, this is sort of like an event style study that I've recoded this, like, I don't know, like a whole bunch of different times. And there's like a lot of annoying and tedious work that is built into now this nice plot that's handed to you, which is pretty cool. So this dotted line, 0 point time axis is basically the time at which we execute on the signal. And then we're looking at, okay, great. So for stocks in the top quantile, or let's say stocks in quantile 1, which is actually the quantile that we're going to be shorting, what is their average cumulative returns forward through time? But what's slick about this plot too is it also looks backward through time, right? And so what you can see is that the time when we're choosing to invest is a time where we're sort of on average. Now, if we put error bars in here, you'll see it gets a little sort of more messy. But on average, you're picking a pretty good time for this set of stocks to be buying the red stocks and selling the green stocks, because you're getting two baskets that are diverging. And so you can sort of look and say, okay, great. Yeah, if I hold this for 5 days, yeah, that looks okay. I've still sort of sorted it. But oh, look, I can get out after 1 day and I can capture most of the power. So that kind of corroborates what we saw. Just to quickly refresh the context, the red ones here are Quantile 3. So these are our highly ranked sentiment stocks. So everything, we had our ranks, and then we binned it into 3 quantiles, with Quantile 3 being the highest rank, Quantile 1 being the lowest rank, and then Quantile 2 being the ones in the middle. So the red line means those are like stocks with positive sentiment, basically, right? Probably. Relative, at least guaranteed relative to the highest sentiment of the group. So the highest sentiment of the group is red, and the lowest sentiment of the group is green. Correct. Cool. So here we put some I guess, variance probably around those. So you can see that, there's a lot of variance in this data. And so we're picking up on small divergences between these baskets still. So here's a time series of that information coefficient. So I already talked, a bit about the power in the information coefficient. It does tend to be kind of noisy on a time series basis. So, this analysis has a year of data. What would increase your confidence probably would be, running this in chunks, or if you have more data, running it over, let's say, a 5 or 10 year period. If you really do see a consistent, an accumulating amount of evidence that says the information coefficient is greater than chance or greater than 0, then that's kind of what you're looking for. And then we can see how that varies over the forward returns periods. 5 day period, 10 day. Yep. And then we're showing you, just the distribution. So you can see that, there's a lot of variance. The variance is larger than the mean. So, okay, we kind of take that for what it's worth. And then we have calendarized returns. Those are just nice for being able to sort of pluck out visually, are there specific times when the signal or these individual kind of three quantiles have outperformed or underperformed just on an absolute basis. And here we're looking at the turnover. So turnover, a time series of the turnover, which remember we looked at a single point number of that in one of the summary tables at the very top of the tear sheet. And then same thing for the factor rank autocorrelation. We saw that single mean at the top, and now we see these as a time series. So on the positive side, they're pretty consistent. We're not seeing like a ton of change. The thing that this told me when Jamie and I went over this tear sheet a bit earlier, here's where we said, okay, this looks really quite compelling. The scale of the IC and the returns, like the direction's right, the scale is pretty small, but okay, this is pretty cool. So here's where we realized, okay, this signal isn't really playing out like exactly the way we might have thought we wanted to design it. And we might go at this point or suggest, you guys might want to go sort of back to the beginning and think about how these quantiles were created. So this autocorrelation is so high, I would think of a sentiment signal having like pretty high turnover. And so what this means that the factor rank autocorrelation is so high is that you're on day one running this analysis and you're coming up with who's in your long basket and your short basket, and you're not seeing, you're seeing it as being a much more rare event that a stock will drop out of your buy list or drop out of your short list. And really for a strategy that you might, truly want to go implement in the market or paper trade, at least, I'm speaking a little bit from our own investment mandate here, where we're trying to think about validating signals and strategies on true out of sample data and accumulating enough kind of statistical rigor to then put real capital behind them. If you're seeing very low turnover, then maybe your signal is predictive and valid over a very long time scale, but it's going to take you a really long time to get confident in that. And just on an intuitive basis, I would think of a sentiment signal as likely having a shorter forecast. So this to me would be the spot where I'd go back and do a little more investigation about the granularity of the signal and say, can I find a way to make, to basically have a higher turnover where I'm placing more independent bets and I can accumulate more statistical power.
Especially since our factor was only a 5-day moving average, right? So it's not that long of a look back.
Right, exactly. Yeah. So, I mean, when we looked at this turnover and we see it's, 10 or between 5 and 10 or 5 and 15%, I was saying to Jamie on just my experience of looking at if this were a 5-day price driven kind of signal, I would be expecting to see like 80 to 90% turnover with a decile type analysis. So part of the low turnover is driven by the fact that we went down to 3 quantiles. So, you have to make a much bigger hop to go from the top third to the middle third of a distribution than you do to go from the top 10% to the second 10%. Right. So one thing, that we could try is making more quantiles, but I know when you looked at the raw signal, there's a lot of, you get into like a classic tie breaking type scenario. So that's the question, is kind of like, how can you kind of tease out enough from the signal to really get into like the evaluating sort of maybe the tails of the distribution a little bit more.
Right. Okay. So, so what I did from here was I really based most of.
Should we talk about that question?
Sure, if you want to answer
sure.
it.
Yeah.
Sorry.
So
there was a question here.
So somebody asked a question, which is, what do we mean by the forward period? And how does that relate to what might be like your optimal trade frequency? So that's a great question. So basically, 1, 5, and 10 day forward returns period, that's 1, 5, and 10. That's basically saying if I bought, traded into this portfolio, which in this case, since we're looking at each quantile alone, it's not a long short strategy yet. It's just like, okay, what if I just bought the stocks in quantile one, whatever it is, the bottom one, right? So I buy these stocks on day 0, and on day 1, on average, my expected return is that I've lost 1%, whatever ish. So, okay, maybe I want to short that basket so that one day later I get out and I've made 1%. So the 1, 5, and 10 days, yes, you would think of them as, if your biggest spread is on one day, then that would be suggesting this is a signal that you should rebalance every day. Another term, if you're looking for kind of references or resources on this is sort of a way to look at alpha decay. So we don't have an explicit alpha decay analysis built into alphalens yet. It would be really cool to add that. But folks will often look at, basically, hey, what's my expected profit, all else being equal, if I exit my positions, again, on average, 1, 5, 10 days out. And so there you're really trying to say, all else being equal, can I try to get at the optimal holding period for this strategy? And a lot of times when you're looking at that, you sort of first might say, let me assume that trading is free. What's the optimal turnover of this signal? If you do that pass, in many cases, especially with like fast turnover input signals, you'll sort of see like this push to be like, oh, I should trade this, every minute of every day. It always looks better and better and better. When you layer in a cost estimate, now you'll start to see, oh, okay, there's a happy medium where the signal's moving pretty fast, but at a certain point, my transaction costs for trading all the time would burn up all my expected profit. So the forward periods are exactly designed to give you some insight into like how frequently you might want to act on the trading signal.
And that's actually a great question because it segues into how I implemented this signal in an algorithm. So 1 second.
Yeah. So when you want to compare factors, yep. So there's another question, which is like, okay, cool. So like, then how do I think about combining factors? So that's like a huge unsolved problem and an area of very active and interesting research. We've written a couple things about alpha combination on our blog, so I would encourage you to check out. Jonathan Larkin, our CIO, did a really nice blog post on quant equity workflow, and he sort of showed where the alpha combination step fits in that workflow, right? So it's like, oh, I've found a bunch of cool alpha factors. Now, how do I plug them together? I'm going to give you like a 60-second quick tutorial, which is what I would do, and what I've always done a lot in my career. It's like simple linear combination of them, just throwing any other info out the window. Comparing them specifically, you're going to do something like maybe look at correlation of returns if you just use factor A and just use factor B, or just correlation of the two factors with each other. So kind of what you're trying to get to is you are trying to find a bunch of independent factors that aren't predicting returns in the same way, that aren't exploiting the same things. If you could posit that you've done that and you could say, oh, cool, I have like 3 independent factors, then a simple linear combination of them is pretty valid. And you can literally just like add up the ranks and average them. You can do more very simple stuff like that's, really a little bit kludgy, but tends to work quite well, which is like weighted linear combination, right? Where it's not equal. And then of course you can get into a dangerous zone of like fitting that, and you'll need to be really careful because you're adding more parameters to a model. Then the one other quick thing I will say is people have realized that where that kind of falls apart are factors that have vastly different alpha decays. And so then you have to get a lot more creative thinking about how do I combine like a fast moving alpha with a slow moving alpha. And that is, that just begets like a whole other bunch of questions, like how do you want to do that? It's not trivial. And so you have to get creative, I think, with how you want to do it. There's some ways to slow some signals down. Probably the kind of like state of the art of what people are trying to do is then use like machine learning techniques to try to come up with dynamic models that are going to weight things in a way that's predictive. So that's sort of like where a lot of the work is right now, is to really say, maybe everybody can get access to the same like 400 somewhat commoditized alpha factors that are all weakly predictive. And then there's this like cool machine learning thought process around like calling those all, weak classifiers and building, some sort of machine learning model around that. So it can go from the simple equal weighted linear combination all the way up to throwing it into some big machine learning model.
Would you say that this plot is helpful at all in terms of looking at decay and how long a signal lasts?
Yeah, absolutely. So like, one thing that's nice is like, let's say I'm saying, okay, I want to build a strategy and I would like kind of want to trade it every week. Then in one sense, if I could find like 6 factors that all had about a week predictive power in them, like 1 week's worth, 5 days,
mode.
And then like they're orthogonal to each other. That is lovely.
Yeah.
And then I'm in a much more complex position if I say, well, I have signals with lots of different alpha forecasts, because now you just get into a tougher scenario of like, well, great. So like you can only trade a given stock. You can only be like long, short, or not holding a given stock. So if you have like varying different horizon signals, how do you like collapse that all in? You have like
on any given day,
like on any given day, you can only like hold a stock long, not hold it, or hold it short. So that's a pretty like binary view.
Right.
But then of course, the other dimension is that you can choose its weighting across your portfolio.
Right, and these are cumulative returns here, so you don't know at what point like most of those returns are coming. So that's what makes it hard. Okay, so I'm going to continue on here. So I use this plot as the question asked to figure out how frequently should I rebalance and which stocks should I buy and which ones should I short. And I implemented an algorithm that goes short in the bottom quantile and long in the top quantile, and it's a daily rebalance because we were looking at these 1-day forward returns. And I implemented it in the backtester, and I will get to that, how I did it. I'll quickly go over the changes I made to the pipeline. So our pipeline earlier was everything down to here, but I'm redefining the pipeline now to use quantiles on top of the rank. So now the output of the pipeline will be, instead of not a sentiment score, not a rank, but it's just going to be a number 0, 1, or 2, representing which quantile it's in. And I'm actually adding 2 columns here, one being shorts, so for stocks that are in the bottom quantile, and longs for stocks that are in the top quantile. And I can actually just copy and paste this pipeline into my algo, which is what I did. And I'll go back to that after, but first I actually want to pull in the backtest result while Jess is here, because she can kind of go over the results with us. So I'm using get backtest to pull it in. And then I'm creating a full tear sheet, which uses pyfolio. And pyfolio is the comprehensive backtest analysis tool
that gives us
yes, the best thing ever. It gives really a lot of detail on the result of a backtest or a live algo. So I'll let Jess take over again.
Sure. So now, we've gone from saying, okay, I have a signal and I want to understand if that signal is useful at sorting my potential investable universe into like good buys and good sells. But at that alphalens report, we hadn't actually bought and sold anything, right? We were just sort of sorting our universe and bucketing it into like potential portfolios and then looking at how those potential portfolios did. Here, Jamie's had to then kind of like make, the implementation decisions of, okay, we're going to, and you did equal weight all the longs and equal weight all the shorts, right? Is that how you implemented?
So a little more detail on the backtest. I took the everything in the shorts basket, which was the bottom quantile, and I allocated 50% of the portfolio short, equally weighted among everything in that basket, and then for the longs, same thing, equally weighted for everything in that basket, but in a long position. So the total of the shorts was 50% of the portfolio, and the total of the longs was 50%.
And I think you said this, but just to recap, so as I'm going to look through this, the other thing that's interesting, right, is, okay, and so you're dollar neutral. That's what that's going to mean. You're allocating like half your dollars to the long side and half to the short side. Cool. And then also, Jamie's chosen to invest in everything that you get that passes as a long or a short.
Right. So everything outside of the middle quantile.
Right. And so that ends up being, hundreds of stocks, which you're going to see it is interesting
like
and drives.
Something or 400. Yeah.
Okay, cool. So this is just showing us a back test. If we had written this strategy 6 months ago or some number of months ago, and then we had fed a live start date into pyfolio, we would get a second column. Actually, we would get 2 columns here. We would get a breakout that shows us for just our out of sample, which turns out to be really critical. I just want to throw that out there because it's great to look at a back test. If we were developing this strategy and we wanted to allocate to it, what we would do is revisit it in 2 months, 3 months, 6 months, and we would look and say, hey, are these backtest statistics holding up on new data? And pyfolio has the ability to do that. So if you have a strategy that you've created in the past and you want to be rigorous and look at, hey, I remember I wrote this strategy 3-6 months ago, and I want to look at how it's done since then, you have a tool where you can pass in the start date somehow. I don't know how, but I think it's pretty easy. You say like live start date. Yeah. And then it will break that out for you. And that is like both a great and a sometimes like really sad moment where you're like, oh God, like I got it looking so great on the back test and it's just like completely fallen apart out of sample. And that's when you sort of have to like look that in the face and move on and try another idea. All right, so let's go through this backtest plot. We said we expected positive returns and we get them, so that looks great.
Oh, should I add the note that I did set commissions to 0 in the backtest because we want to look at just the impact of the signal.
Right. So this first run through, and Jamie and I looked at this a couple of ways. So, and I will say in our internal research team, usually what we do is start off and do a first pass where we remove slippage and commissions. And that's just so that we can see, hey, in a perfect world of 0 friction, how does this signal look? And then we can layer the cost back in and think about when they sort of tip over into the strategy not having an positive expected value. And then that's when you can start to think about, maybe I need to modify the way I'm trading this signal. Maybe it can still overcome transaction costs if I just tweak it a little. So right here, we're looking at a 0 cost tear sheet. So really what's probably the most promising thing that we like is while these returns, are going to look small to you, what we care about in quant world is the Sharpe ratio or some risk adjusted measure. So we're actually cool with maybe making 2% on a strategy that only has 1% of volatility. The reason that quants tend to think that way is because if you have an extremely low volatility signal or low volatility strategy, that has very low risk. And so what you can then do is apply some leverage to that. You can borrow some capital. And so this is like definitely not the way that a retail investor necessarily should or would think, because a retail investor might be thinking, leverage, if you hear leverage typically kind of from a retail investor, you should be worried, right? That's, at least I would typically think of that as like, oh, hey, I can go trade options or currencies and someone's going to give me 40 times leverage, and that we think of that as very risky. The key difference is you have to know and be confident that the thing you're investing in is actually low risk. So if it's low risk, then that means that when you apply leverage and you sort of scale by a factor of 2 or 4 or 6, everything about your strategy, you're not going to cross the like bust point, right? And so, you think your highs are going to get higher, your lows are going to get lower. And the lower variance signal that you have, you can think of it as sort of like just draw like a straight line. If you have like a straight line equity curve, you can apply leverage and change the slope of that line. And that is great. And it's kind of like all win. But if that line has wiggles in it, as you apply leverage, you increase the slope and you also increase the peaks and the troughs. Okay, so this is cool. We like to see a Sharpe ratio of greater than 1. We feel like there then is something interesting there. A lot of other cool stats that I won't really go into. The only other one I'll highlight is our beta is rounding to 0. That means our correlation with the greater market is near 0. That's also a positive thing from like an institutional quant standpoint. As a quant who's trying to market maybe a strategy and have someone invest and pay you a fee for it, kind of makes sense that, you can get very cheap exposure to the market by going and buying an extremely low cost ETF or index fund. That's going to have a high beta, high correlation to the market. If you want to have a strategy where an investor is actually paying you a larger fee for your intellectual property, for your ideas, they don't want to pay you for this really cheap thing that's out there, which is exposure to the market. So if you are trying to sell a quant strategy, you often really wanting to be showing, I'm not taking any exposure to the market, because that investor can go buy that market exposure much cheaper than what they're paying you somewhere else. So we are happy to see low exposure to the market, small drawdowns. That's great. When we're reviewing strategies for allocations in our fund, we're typically looking at, maybe longer time ranges. And our cutoff really is if we see something that has a drawdown that's 20% or more, that's kind of a tough one for us to get over. Whereas we see drawdowns, certainly a couple percent, that's very, very small. But even if you're talking about drawdowns that are in the 10, 15% range, if that's over like a 5 or 10 year period, that's actually something that's still marketable. So again, you kind of look at the cumulative returns curve, and on the one hand, if you're looking at the SPY in the background, you're thinking this doesn't look so hot or so exciting. But again, kind of remember and picture yourself here at the peak in October or mid-September of 2014, before you were about to lose, 80% or 70% of those gains you had accumulated. If this were like an investment strategy or an investment manager, all your customers are going to leave you. All your investors are going to redeem their capital if they can, and they're not going to tolerate this level of drawdown. Whereas while this green line, has a lower slope, it's a lot less scary of a ride. That's one way to think about it. And a plot in pyfolio that kind of shows you that is this next one, which says, all right, but here are your cumulative returns. Let's match the volatilities between the strategy we're looking at and the benchmark we've chosen. A sidebar would be to say that for a quant strategy, you don't typically think about how it's doing against the market, since I just made this big deal of explaining that we're explicitly trying to make sure we're not correlated to the market. So instead, your benchmark, would be something that you might be able to get from like a hedge fund return index database, or basically your competition. If you're selling your investment services, then you're going to try to go and say to investors, hey, well, what are their other options? But I think it's really helpful to be able to sort of see in context. This plot that's volatility matched is a little bit more of a fair comparison. The log scale doesn't look that exciting here because we have a really small return and a low time scale. We're looking at the returns over time. This plot's nice for catching if there's any sort of anomalies or really big moves. We like a really, really boring beta time series plot. So like no beta ever. That's fantastic. Rolling Sharpe ratio. This one's kind of interesting for this strategy. And I encouraged Jamie, or I would encourage you guys as a follow-up, we didn't do any analysis here, like checking the correlations of this strategy to other commonly known sort of quant factors. I was saying this is interesting how the strategy does, pretty well with a rolling Sharpe of, above 2 for sort of the first 3 quarters of the year. And then it's really at the end of the year that it sort of takes a hit. And that might be something that's related to, a structural market factor or something when, mean reversion or momentum or some other signal that it's kind of piggybacking or exploiting. It's really funny. I was like, what happened in the beginning of November? So it could be a number of things that could have happened. Oh, that's 2014
Yeah.
now. You're choosing 2014. Okay. So a lot of times it's interesting to be able to actually think about what happened in the market in the time ranges that you're looking at as well, especially if you see something like this did well for 10 months and then did poorly for 3 months. If you had a 10-year back test, you could sometimes pick out things like, this signal did well across these years and these months, and there could be something you might learn about.
Remember, this one's delayed too. So this is the 6-month rolling value. So this first point here is like that whole 6 months, right? Exactly. So this here is really from this period,
right? But still, you're falling off towards the end. Yes. So like something less good happened for this signal in the last third or last half of the year, basically. Not a super exciting example, but again, this is kind of what we like to see. So this plot shows your betas to other, sort of common risk factors, cap, growth, and momentum. So I won't spend too much time talking about those, but basically there's kind of like classical risk factors in quant when people think that, hey, you can make more money buying small caps than large caps, but actually that's basically that you're taking on risk. And, your average small cap stock, while it will, on average, tend to maybe do better because it has more upside potential, but on the other, can grow. But on the other hand, it's more risky just because it's smaller. So more likely to go out of business. So small cap minus big caps, that's blue. Growth, high growth companies tend to outperform low growth, but at a cost of risk. And stocks that are trending up tend to outperform stocks that are trending down. That's kind of a momentum. That one's really on the line in quant. There's, some people think of momentum as a risk factor, and some can think there's types of momentum that are directionally predictive and that are can be an alpha factor. But we like to check correlations to those 3 classical factors. Then we're looking at when our drawdowns occurred. So here's what shows us, this was really rough. So from August on, the signal was in a pretty strong drawdown. But again,
for the y-axis.
it's like on a relative basis, but it's tiny. So, really we wouldn't be that concerned about that. And okay, like we tested it for a year, right? And it had, one up month the end of 2013. And actually, it looks decent. It looks pretty interesting. if you have a bunch more months, this distribution of monthly returns plot becomes kind of more and more compelling. And same thing down here. This is actually this plot gets really cool when you have out of sample data, because this returns quantile plot, it's showing me like, so do you like box and whisker better than a violin?
I do,
okay.
because I understand them.
Yeah. Well, the violin, I think, is just like another visualization of the same. Anyway.
Yeah, it's very simple.
So here's your nice little box of whisker. And what's cool when you have out of sample data is that we overlay the out of sample data points in red. So you actually can see, like, does your out of sample data, sort of pepper the same space that your in sample data was. So if you had like 6 months of out of sample data now, and you were seeing like a bunch of red dots, like above or below this historical distribution, that would start to raise a red flag. That you weren't seeing a similar distribution in your out of sample as you did in sample. We have a bunch of hard-coded stress events, which are really just specific time ranges historically that we think it's interesting to zoom in on and see how a signal did versus the background market context. So we happen to, and basically depending on the length of the backtest you hand in, you'll just get the number of stress events overlapping that occurred during your time period.
Right. So I'm missing everything in 08 because I didn't run my backtest that far.
Exactly. Back. So these are, these are the ones that that we have data for, basically. And now we get into what I tend to think is like, here it's like a little bit less exciting. It's awesome because what we're seeing is we're just holding like lots of different, things with a tiny exposure. So we have small exposure to any single stock. For me, when I'm trying to vet and due diligence on a strategy that I have found and I'm grading and I'm trying to see if it looks like something Quantopian should allocate to, this tends to be where it really reveals to me, like, is this something that I think is compelling or not? Mainly because if I am looking and you see here top longs and top shorts and you see just a few names with 30 to 50 to 80% concentration in those stocks. And then you'll see lower down, we look at the concentrations and the position sizes over time. The bigger exposure you have to any single name over time, that's just a lot of risk. And that is like a common failure mode in strategies that we evaluate on the platform right now, is that I think a lot of strategies, people are not necessarily developing them necessarily with an eye for Quantopian to be reviewing them and thinking about using them as an institutional strategy. And so they may be doing something where they're picking a smaller number of stocks. And then that's going to have, sure, that may look really good over a time period that small number of stocks continues to consistently perform well. But like, let's say you're holding 6 stocks in like some similar pretty high weight, then the probability that something could happen to one or more of those stocks that you don't expect in your model didn't take into account, if something does happen that's not really modeled and that has an adverse reaction in your algo or you lose money in, that's a huge portion of your portfolio and has a really big outsized effect. So that's kind of one of the things that's most compelling is this strategy is, oh wow, we really are placing, we need a lot of money to run this strategy because we would need to invest, money in hundreds of stocks. So that would be expensive.
And there was a question.
Yeah, we have a couple questions. So
capital allocations without using too few quantiles.
Oh, so I think the question, because I started talking about kind of what I'm looking for and about the fact that I'm looking for strategies that I can put more capital behind than what, you might think of yourself being willing to put in, your 401k or sort of take, a $40,000 investment. You can just only buy so many shares of so many companies, right? So some of the tips for looking for high capacity strategies are basically to vastly increase the size of the universe that you're going to look at. We have a lot of tools that let you test that. Not, I'd like to make it even more easy, but what you can do is up your starting capital base from 100K to, 1 million, be reasonable, put it at 1 million, and then see, okay, if I'm using, a universe size of 1,500 stocks, well, all right, like how many stocks do I think I can trade on $1 million? So maybe you want to start looking at a portfolio size that's 100 names each side or 200 names each side. And you can start to see, like, does this signal have power with that size of a portfolio? A couple of the other key things that will help you, and then if you do them ahead, we won't have to coach you and tell you to do them, are if you want to trade a bunch of capital through a strategy, the other really big capacity limiting thing that people don't think about is you want to screen out instruments that themselves have very low capacity. So Quantopian presents to you a very broad universe of tradable equities, which includes micro caps and includes ADRs and includes,
Or it excludes those.
Well, no, we if you don't use one of our universes, you can access like anything.
8,000 stocks, anything
Exactly.
trading on NYSE, NASDAQ, or Amex.
Exactly. And so if you don't either create your own filters to get down to like a reasonably high capacity universe, or use one of our predefined ones. So here you're using the Q1500.
Yeah.
So I would say, use one of those pre-built universes, because we've done a bunch of the legwork to screen out a bunch of really low capacity stuff. Because that's really the other like biggest capacity limiting thing that we'll find is if someone's designed a strategy and it trades a lot of names, awesome. Sometimes it looks really, really good. And then you realize when you do some attribution, a lot of the profit is being driven by really micro cap stocks, which probably we wouldn't maybe be able to get short locates on, right? Or would be have a high market impact, which we model market impact, but you can always we're continuing to work on sort of more sophisticated ways to get that even more accurate. So the other thing is really just sort of saying to your strategy, take things off the table that themselves would be a real bottleneck for your strategy capacity wise, because even if you're investing, let's say, I typically am looking for a strategy that doesn't ever place more than 10% of its portfolio in any one name.
Well, that has the two advantages, right? Of now you have less position concentration, so less position exposure, and you probably have higher capacity.
Yeah, exactly. That's right.
So two benefits.
Yep.
There's a quick question here. Does the Q1500 ensure liquidity? I don't think it can ensure anything because it's only using past data, but the question has a second part, which is, does it include dollar volume or anything else? Yes, it looks at volume, but it does look at dollar volume. It looks at market cap. It looks at...
Yeah, it's a good starting point. It's trailing end day.
I think it's like 200 days.
Volume.
200 days of...
Yeah.
There's a lot of work that goes into it. And it's all very well explained in a forum post. So if you're interested in more about how the Q1500 or Q500 are built, there is a forum post on that.
Yeah, and in general, if we have done a good job, then the intent is that the Q1500 is a liquid tradable list that we would allow you to trade anything in it. We intend probably to expand our tradable universe to something like the Q3000, let's say. But right now, when we launch when we launch our institutional account later this year, we'll probably be sort of wanting to start with a little bit of a smaller universe, but 1,500, 3,000, like that should be tradable. If you find stuff in there that isn't and has gotten through, please give us feedback. And one of the cool things about having those in universes open source is that we want to kind of continue improving them and making them bulletproof.
Before we go to any more questions, let's just finish going through the tear sheet here.
So you were able to sort of see what our long and short exposures are. Those are very small on each side, and they're roughly consistent.
That's related to the low turnover too, but still good to see.
Well, no, that's fine.
Yeah.
If we had high turnover, you could still see them being very consistent. It's just that we like to see them nicely balanced. Yeah. We're holding the same number of stocks pretty much every day. That's how the strategy was designed. A lot of times that will catch for you something where you didn't realize that you didn't have a clean way of perhaps a stock exiting. So looking at the holdings per day is a kind of a good sanity check and data quality check sometimes. And then we're looking at our gross leverage over time. That one's not like a huge deal for me when I'm selecting strategies, because what we tend to do is just look at what the leverage is. And then if someone's applied, 2 or 3x leverage to make something look good in the contest, and we select them for diligence, we usually just say, hey, that's great. Let's go and back test and run the strategy at 1x leverage just to see what does it look like on its own. And then we can always apply leverage back over the top of it if we decide that it's low enough risk. So you just want to see like that the leverage is being managed. For me, It's a lot easier to wrap my head around how we'll trade a strategy if the leverage is pretty consistent, although we have selected strategies who do dynamically measure their leverage and sort of go between 0 and 1 over time. The more kind of traditional institutional quantity type strategy would be to have ideally a more consistent leverage, because then that way you're like utilizing all the capital you have at your disposal all the time, so that if you have some positive expected value on that capital, you kind of want to maximize it, basically. So looking for consistent leverage. And then we talked a bunch about turnover. So the turnover is really low, and we'd like to dig more into, why that is. And, we don't have a strong turnover target, too low. And basically we think it'll take too long to accumulate statistical power on the out of sample to get comfortable. So that's why we've been skewed a little bit towards preferring higher turnover. Anything that's trading, once per day, week, month, that's within the realm of something that's interesting to us. Turning the whole portfolio over once a day is high turnover for us and is expensive, but we do have stuff that's in that regime.
And on that, the reason you need to wait longer is because I think Jonathan talked about it in his blog post, but with less turnover, you place fewer bets.
Yep.
And so just the probability of being right is higher by chance.
You just have a small n.
Exactly.
So like you can sample, 10, you take 10 samples from a distribution. Is that enough to tell you what that distribution looks like? Probably not.
Right. So more trades,
take 1,000
more
samples. Like, okay, you can probably have a pretty good idea.
Right.
That's right.
Okay. And I mean, I guess there's just more on that. So, all right. Do you want to take it to questions then?
Sure.
So,
did I answer?
I just skipped over a couple.
For implementation, there was a question about how to emulate factor-based weighting shown in alphalens plots via the IDE. So it's really, I think, all about evaluating what you see in alphalens and then converting that to a factor. So what I did...
But you can still run an alphalens on a meta factor, can't you?
Yes,
on a combined
you can.
one.
So the key is you can combine pipeline factors into a single factor at the end, which you can then put into alphalens. So the question was on how to weight and combine different factors and implement that in the IDE. And so one way would be to create several different factors, evaluate them independently with alphalens, but then you could actually experiment with combining them and putting that combination through alphalens. And then there's this question here.
So if you had a $10 million allocation in a long-short strategy, how would you think about the likelihood of being able to get that short? And I'm not sure actually if this means a $10 million single position. I'm going to assume it means a $10 million portfolio. So great question. And one of the things that we don't have in our platform right now is a historical hard to borrow or borrowing cost modeled. So the best proxy is sort of liquidity. So if you are screening out illiquid things, then you're kind of going to say, I'm going to have to trust, I think I would have gotten these shorts. That's kind of decent first pass approximation. In our infrastructure, when we're trading our institutional capital later this year, we have built a whole bunch of separate stuff, which what you do is you ingest like a hard to borrow report from your broker every day. And so what we'll do for the algos trading in our platform is we'll overlay a separate restricted list. So it should pull that hard to borrow stock out of your portfolio before you run your signal that day, hopefully. So we'll help algos take that into consideration. Probably a good way to think about that when you're designing your strategy is a strategy that's designed to have a dynamic universe that can sort of be flexible to checking, hey, what's available today? Rank that, buy the best things, sell the worst things. Something like that that's resilient to having its universe sort of updated and having things come in and out of the universe is going to be a lot more robust to hard to borrow. Whereas if you've designed a strategy that specifically has like a static list of positions it wants to hold, like let's say Tesla might be a good example, or a lot of like sort of sexy tech stocks that are like, oh, super darlings 1 minute, and then like everybody wants to short them the next. And if you think like, oh, I have this really powerful signal on, Tesla or somebody, well, you could go check. Actually, I mean, there's a separate, we don't have this data on our site right now, but and I haven't been doing this recently, but I know in my old job, I used to be checking a lot I'm sure it's still available, shortsqueeze.com or something like that. It's pretty awesome. And like you literally just type in the ticker, and it tells you whether that, like, so you can sort of spot check some of the names, that
I'm not going to Google that while we're live on the webinar.
Okay, yeah. Well, it's actually great. I mean, if it's still the same website that I remember, it's pretty sweet because it does show you kind of all that data that you'd want. And so, I think hopefully sooner rather than later, we'll make that available in the Quantopian platform. And then you'd be able to build that into your algorithm development process, being robust to hard to borrow stocks. For now, since you can't, the best thing you can do is to try to be conservative with the liquidity of the universe that you select. You can kind of say that illiquid stocks will more quickly become hard to borrow. I mean, I could go on and on about that, but that's sort of your best approach right now. And then, we can sort of help you with that if it comes to that point.
Does anyone else have any questions for Jess? If not, I'm going to let her go, and I'm going to show you quickly what I did to take this pipeline to the IDE and backtest it. So I'll just give you guys 30 seconds to type out any questions if you have them.
All right.
All right, radio silence. So thank you so much, Jess.
Thanks for having me on your show.
That was great. I found that helpful as well. I hope you guys did too. So I'm actually going to go right back up here to before running this pyfolio tear sheet. And right here. So before we had our pipeline defined as everything right up until this point here. And we saw in the alphalens report that I was using 3 quantiles, and that, again, I should be shorting the bottom quantile and going long in the top one. So I added a dot quantiles here, which turns my sentiment rank factor into a classifier, which assigns a quantile to each stock in the universe based on their sentiment rank. And then what I'm saying here is I'm creating a column for shorts and for longs based on, so anything in the 0th quantile, which is the bottom one, added to the shorts column. Not quite. It actually creates a Boolean that'll give me true if it's in this quantile and false if it's not. And then similar for longs, it'll give true if it's in this quantile and false if it's not. And the reason I'm doing this is because it actually makes it really easy to go from here to the IDE. Easy enough that I can actually just copy this pipeline. And then I've already coded everything out, but I'm just going to show you that I literally copied and pasted my make pipeline function right here, and I just paste it. And this is my make pipeline function. So it still gives me a pipeline. The difference is in research, I had to use the run pipeline function and specify a start date and an end date to run my pipeline. In the IDE, I use this attach pipeline, which attaches the result of make pipeline, my pipeline, and it'll compute it every day. And then here we saw that we were looking at 1-day forward returns, so I'm scheduling a rebalance function to run every day, and I just picked some time, market open an hour after it. And then in before trading starts, so this is before trading starts every day, I get my pipeline output, which is the pandas data frame, assign it to context.output. My securities are in the index, and I convert this to a list. So I have context.security list. And then my rebalance function, which I scheduled to run every day, simply just takes everything where longs is true. So this is the same as saying everything in the longs column, which is true, and get the index of those. So these are all my securities that were in my top quantile. And these are all the securities that were in my bottom one. And here I'm just saying I want 50% of my portfolio divided by the number of securities that I want to go long in, so equally weighting them. And similarly with the shorts, I want negative 50%, so that means go short or create short weights. And then I just iterate over my long securities, ordering to that long weight, iterate over the short ones, ordering to the short weight, and close out anything that is no longer in my short or bottom or top quantile. So this is anything that moved from either completely out of my pipeline or to the middle quantile. And then I have this other function here to report certain metrics, such as number of longs and shorts per day. And then I already ran this back test, so I'm going to save you the time. But here it is. And this is the back test that we pulled into pyfolio. So yeah, that's it for today. Some things that Jess pointed out that I think I will work on for maybe a future presentation were that daily turnover, ideally getting something that's a little more active. Something else is when we were researching our data, we didn't actually spend that much time looking at the distribution of our sentiment scores. So for all I know, half of the stocks were extremely negative and half of the stocks were extremely positive. And one thing that might be nice to do is try and create a uniform distribution of sentiment. So maybe there's some more playing we can do with the raw data before we actually create our factor. So, and I guess the one other thing that's been going around the community is the Optimize API, which if you haven't heard of it, it's something that you can use instead of order target percent to specify an objective portfolio, and it intelligently picks your optimal portfolio based on a series of constraints and an objective. So when we get some documentation out for that, I'll probably revisit this example and add that into the algorithm. I have one more question here, which is about whether alphalens assumes a leverage of 1 and I would have to investigate that. I believe the answer is yes, but I can't say for sure. So that alphalens is open source. You can definitely look into the source code for that. I think the answer is yes, but that's about it. So any other questions on, I guess for me, on pipeline or Blaze or anything outside of the tear sheets? All right, well, thank you guys so much for joining today. I posted the notebook above. It is in the community, and I hope you found this helpful.